welcome to the program. I am Bisi Adebayo. In a few hours, the governor of the Central Bank of Nigeria, Godwin Emefiele, will be announcing the outcome of the two-day meeting of the Monetary Policy Committee, which is the last for the year. The MPC meeting, which comes a few days after the release of the third quarter GDP figures, is expected to address key economic issues such as the rise in inflation, as well as the combined impact of coronavirus lockdown and, of course, the drop in oil prices on the country. At its last meeting in September, the committee voted to cut monetary policy rate by 100 basis points to 11.5% and adjust the asymmetric corridor to plus 100, minus 700 around the NPR. Channels Television will be bringing you a live coverage of Mr. Emefiele's briefing at 2 p.m. today. Meantime, Brent crude prices hit their highest levels this morning as the news of a third promising coronavirus vaccine candidate spurred hopes of a quicker recovery in oil demand, while the U.S. President Joe Biden received the go-ahead to begin his leadership transition. Brent crude futures rose 0.9% to $46.49 a barrel, while US WTI added 1.1% to $43.51 a barrel. Brent rose to a session high of $46.56 today, and that's the highest level traded since early March, before Saudi Arabia initiated a price war with Russia, which sent oil prices crashing. Now, both oil benchmarks settled up about 2% on Monday after gaining about 5% last week. And back home now, in recent times, one sector that has continued to distinguish itself remains the information and communication technology sector. Although the Q3 GDP data shows the sector's contribution declined to 9.57% from 14.06% in the second quarter of 2020, but many still believe the sector plays a significant role, especially as the country journeys through the path of economic recovery. I was speaking with the immediate past president of the Institute of Software Practitioners of Nigeria, Mr. Yele Okeremi, about this. Good morning, Mr. Okeremi. Thank you for joining us on the program. I'd like to start by asking you, what was responsible for the drop recorded by the ICT sector in the third quarter? Many would have thought that the growing use of technology, especially owing to the COVID-19 pandemic, would have led to more growth. What actually happened?
So when you talk about percentages are relative. You talk about percentages of contribution to GDP. First of all, you look at the fact that in absolute terms, actually the figures may have dropped. But when you talk about percentages, it may be as a result of some other aspects of the economy rising during the period in question. And so if you take a look at what has happened in this past quarter, it's a pandemic season. So you expect that there will be a lot more contribution in healthcare and stuff like that. So that might be a bit responsible for a drop in the percentage of the contribution to GDP of technology. However, the figures themselves, yes, you see a drop in the figures. That again tells you it's about the challenges that people are facing. Businesses are kind of challenged. The number of businesses are not working in full capacity, not working to full steam. Logistic chains and so on and so forth are also challenged under the pandemic, where you have lockdowns and restriction of travels. So all these things will definitely account for a drop in contribution to GDP of the IT sector.
Well, would you say that, you talked about percentage terms now, but do you actually have an idea how the contribution to the GDP is actually measured? You've talked about some factors now, but I would think that if, remote working has been the order of the day. For instance, myself, it took about 2 hours for me to get to work this morning. I had to prepare for this program using my mobile phone, and we've seen a surge in that kind of activity. So how do we actually measure the true contribution of the ICT sector to the economy?
Speaking as an economist, there are three approaches to GDP measurement, but some of them are technical. I'll try to explain how these things are done by economists to you. So the three approaches, and the most common is what we call the expenditure approach, where we talk about the GDP being equal to the consumption in the economy plus investments, or what you call investments or savings, plus government expenditure plus exports minus imports. So that's the equation for measuring that. That's one approach, the expenditure approach. Another approach is the income approach. And then the last approach is what they call the value added approach. So if you take a look at but all of them will give you about the same figures actually for measuring GDP. So if you take a look at all these aspects I'm talking about, you are looking at, it is measured by how much money has been spent in the field in using technology. And just like you said, yes, you say that you are using a lot of airtime, but remember that because many companies, for example, are not fully open, including my own company. So what's happening is that many companies normally that would have purchased equipment, that would have purchased laptops, purchased servers, desktops, those have not happened in recent times. And if you take a look at what has happened, these things actually do have multiplier effects. So if you take a look at even the purchasing managers indices, generally speaking, this has dropped. And if you take a look at even naturally look at households in terms of what they consume, because their incomes are challenged and dropping, naturally their expenditure will drop. And so you would expect to see a drop in GDP. And particularly talking about IT, you realize that, yes, I agree with you. A lot of people are spending money on airtime, but people are not buying new mobile phones, for example. People are not buying computers. People are not buying new software. We are not having major projects, major IT projects happening around. Definitely, those will affect the contribution to GDP of the technology sector. Absolutely, yes.
Now, you talked about the purchasing power of the people. Of course, you say it has dropped due to the pandemic and all. Now, of course, let's not forget access to Forex. I mean, a lot of these gadgets have, the price of these gadgets have actually skyrocketed in the market. So where does local manufacturing come in here in terms of manufacturing the mobile phones and the laptops? How would you say that Nigeria is faring in this regard?
As far as I'm concerned, we are not doing well enough at all. So, generally speaking, this is the strategy and the approach to be adopted by smart nations. We call it comparative advantages. Nations should look at areas where they will be, comparatively at an advantage. So, if we talk about manufacturing of, mobile phones or laptops, we want to ask ourselves, what are the real factors that are important in manufacturing these things? So you look at the raw materials. A lot of the raw materials are electronic components, and of course, then you look at the labor, which is and the technical know-how. Absolutely, we have the labor, we have the technical know-how, but we do not have an industry, for example, for ultra-large-scale integration of microchips. So what we are going to be doing most of the time in Nigeria is more of assembly rather than actually manufacturing a number of those components. And I'm not saying any nation in the world is self-sufficient to do some of these things, but there are some nations in the world that are a lot better positioned than Nigeria for manufacturing of ICT equipment like mobile phones, like you say, and laptops and servers. But having said that, I think we as a country might decide that, yes, we want to use it as a catalyst for creating employment. So even if we wanted to do what you call CKD, a complete knockdown part, where you brought in all the components and then you assembled that, yes, that's a possibility. But remember that in trying to do that, a number of factors also come to play. Some infrastructure that we currently lack. And you just give an example that it took you 2 hours to travel from your home to your office. So that's most likely because of bad roads, because of bad behaviors on the road. So the same thing is going to happen if goods were moving. So you realize that when goods are moving, the supply chain is going to be challenged. The goods are not going to arrive on time. And so you see that these are the kind of challenges that the nation will face, even if we attempted to go into such fields. And so we'll say that if we want to go into such fields, we really need to look at our strategy as a nation again.
About the strategy now, of course, no doubt the COVID-19 pandemic has shown how critical the ICT sector is to the growth of the country's digital economy and, of course, by extension, the general economy. But do you think that the government has done enough to tap into the potentials of this sector?
Absolutely not. I'm not saying they are not trying, but you see, the issues about ICT, we have to understand. I mean, one of the things I say is that there are two ways. If you came into a room like where you are sitting and where I'm sitting, where there's an air conditioning, there are two important components in the air conditioning system. One of them measures the temperature and tells you that this is the temperature. The other one, and that's called a thermometer. The other one determines what the temperature will be, and that's called the thermostat. That is what determines when to cool and when not to cool. I see the government of Nigeria behaving like a thermometer, just telling us, oh, this is where we are. I do not see them having a plan to decide exactly where they want the country to be and pursuing that doggedly. And I'll be very specific. So if you talk about technology, there are two approaches we can look at technology from. One, we can look at technology for the sake of technology, and we can look at countries like India, for example, that have used technology as even outsourcing as a basis for creating exports. So they focus on it, they focus on development of intellectual property, and they keep exporting. Look at China, for example. They manufacture a lot of these things and they export. That's one approach. Another approach is we can decide we want to use technology to consume it smartly. And I make specific reference to a conversation that was had by the current Prime Minister of Israel. And he was talking about technology and Israel. He said, one of the things he said is, number one, all the major IT players in the world have one research center or the other in Israel. How many do we have in Nigeria? Even they are going to Ghana at the expense of Nigeria. Secondly, he mentioned that look at agriculture in Israel. Agriculture in Israel is completely an ICT game. It's a complete tech game because in Israel, at crop level, they are able to determine at crop level using technology what the needs of the crop is. They are able to use predictive analytics to determine which crops are likely to do well, and they are able to respond in real time. Now that's using technology to be a means to an end. For me, I see us spending a lot of money on technology in Nigeria, but I still do not see a strategy to make sure that this technology produces reasonable multiplier effect. And I can give more examples. Take a look at our oil and gas. I mean, if we agree, for example, that Nigeria, the mainstay of this country is still oil and gas, we can agree on that. I mean, there's no problem about that. But how much of technology that is local are we putting into that? So we still have to find technology companies in Nigeria struggling to pitch to major to the multinational oil companies. That doesn't make sense to me. If we really want to do the right things, then we can decide, for example, the oil and gas, yes, because the oil belongs to Nigeria, we want to develop it, but we want a minimum of 70% of technology to be used to be local. Take a look at our education. Let me be very clear about this. It is absolutely impossible to create the number of classrooms that are required for us to get to a reasonable level, except we use technology. How much of that are we using? Every day, the government tells about trying to build classrooms. It's outdated. The important thing right now, the reasonable way to go forward to achieving this is using technology, and not just using technology like I keep talking about. I say if we really want reasonable contribution with a good multiplier effect, the technology has to be local.
Now, you talked about education now, for instance. Remember that during the lockdown, most of the schools had to adopt the e-learning strategy to, continue with the activities. But then you had several parents saying that it was quite expensive. The cost of data is quite expensive. So how do we put all of this together?
Now, you see, that may be true. But again, it's relative. You see, when you look at, that's why I say, if we begin to look at them in silos, we might say, oh, it's expensive. But I can tell you for free, for example, that if you really have a system, okay, Let me give another example, and I'm going to be very relative to that. So many schools, particularly even in Nigeria and overseas, their curriculum is available online. For those of us that have children at school abroad, they cannot go to school. They are also online. Now, the real reason why we say the cost may be high is that, yes, the data is something. Again, the cost may be high, it needs to be brought down. And that's why I spoke about sustainable strategy. So when we have a strategy in place, we will decide what are the levers that drive what we want to achieve. So, for instance, if we realize that the cost of connectivity is something that needs to be looked into, absolutely no reason why the government cannot incentivize or subsidize on the short run. I'm not an advocate of long-term subsidies, just so that we can create better results. But in truth, whether we want to accept it or not, the future is upon us already. Education can no longer be the way it used to be. Now, let me give you a very simple analogy. You see, people have answered these questions. If I ask you who creates more value, is it a school professor or a basket or a footballer? Most likely you're going to tell me that the school teacher creates a lot more value. But who makes more money? The footballer, of course, makes a lot more money. And the question is, why do you think the footballer makes a lot more money? Because indeed the footballer, while he's playing, there are 22 of them on the field, but more than 40 million people are watching via the internet, via television, while a classroom teacher is limited to teaching 30 people at a go. And yet to say the school teacher is adding more money, more value. Economics teaches us that money is a store of value. The only way to create value and to multiply value in the education system is to go tech, such that knowledge that is being created by teachers can be digitized and can be shared and can be utilized by a lot more people than they currently serve. Absolutely, when we do that to scale, you will find out that the cost is going to drop per unit.
All right, Dr. Okeremi, we need to wrap up this conversation in just about 2 minutes. But before you go, the federal government has projected a 21% digital economy penetration by next year. Are we on track to achieve this?
It depends. So it's a good ambition. But like I told you, if wishes were horses, beggars will ride. It's good to say we want to do this. But the question is, what's the roadmap? How did we arrive at those figures? And exactly what are we doing? So let me give you specific examples. If we are not doing these things to create economic value, we are still wasting time. Look at it this way. How many of our rural areas can we get to? First of all, we have electricity problems. Talk less of having infrastructure, technology, infrastructure getting there. I think it's going to be challenging. It's a good wish, but I wish that we could have a better strategy around it and ensure that that strategy works for us as a nation.
Thank you for your time this morning. It's been quite an interesting conversation with you, immediate past president of the Institute of
My
Software
pleasure.
Practitioners of Nigeria, Dr. Yele Okeremi. Thank you, and do enjoy the rest of your day.
I wish you the same. Have a good day. Bye.
All right, we'll be discussing today's burning economic issues at the domestic commodities market, and that will be when we return in just a moment. Please stay with us. Welcome back. A research analyst at the financial derivatives company, Desola Simoni, joins us now to run us through today's burning economic issues at the domestic commodities market. Good morning, Desola. It's good to see you again. Nigeria is officially in a recession after 2 consecutive contraction in GDP numbers. Of course, many had expected that the figure should have been higher than the 3.62%. In fact, the FDC had predicted a 4.7%, but does this mean that we're kind of on a path to recovery despite the contraction?
Thank you for that question, BC. I would say yes. I mean, everyone, the analysts, the consensus of analysts knew that, Q3 GDP numbers will be smaller than those of Q2 because of the better than expected improvement in economic activity after the lockdowns were lifted off in the summer. But the magnitude of the contraction was anybody's guess. Also, we've seen leading economic indicators such as the manufacturing purchasing managers index show consistent increase in the index, but it was still below the neutral level. So everyone knew that, yes, things are getting better. The economy seems to be recovering, but not sharp enough. More is needed to keep the economy on the path of sustainable recovery. We need rapid implementation of the economic sustainability plans. We need more coordination between the fiscal and monetary authorities to stimulate economic activity, particularly for small and medium scale enterprises, so that would boost employment, and that would keep us on the path of sustainable recovery.
Now, the Central Bank's Monetary Policy Committee will be giving key monetary decisions reached at the final meeting of the year by 2 p.m. today. What are we likely to expect owing to the economic recession and the hyperinflation facing the country?
In a nutshell, we expect the central bank to, we expect the Monetary Policy Committee to hold all monetary policy parameters unchanged. But let us backtrack a little bit and look at the factors that the central banks are considering. The central bank is considering. The first one is the hyperinflation, currently at 14.23% for October. We have the economic recession, like we spoke about earlier. We have the exchange rate misalignment. We saw the exchange rate depreciate to record lows of 484 naira to the dollar last week. And we are seeing this high rate of unemployment. Last figures from the Nigerian Bureau of Statistics shows that it was at 27.1%. So let's also now consider the options. So for the option to tighten, the central bank has already said that the inflation is driven by structural factors rather than monetary factors. So using monetary policy tools to address inflation driven by structural factors would be important. So increasing interest rates at this moment may not be the optimal solution, because that will also increase the cost of production, increase the cost of credit. It will stifle credit to the private sector, and to dampen or slow down economic recovery. Loosening, let's consider the option of loosening. Loosening, while it may support credit to the private sector, while it may stimulate economic activity, it may also stoke the fires of inflation and mount pressure on the exchange rate through naira liquidity. So the optimal option, or the risk-free, the riskless, no, not riskless, the more safe option is to hold all monetary policy parameters unchanged, in order to assess the effect. In September there was a surprise cut in monetary policy, the monetary policy rate. So to assess the effect of that, as well as other measures that have been implemented to bring the economy on the path of sustainable recovery.
I guess we'll just have to wait for about 4 hours or thereabouts to know the decisions of the MPC. Now let's talk about oil, yes, which accounts for majority of our reserves. It seems to be doing well, as at this morning, Brent had touched $46 per barrel. Of course, that's higher than the budgetary allocation. So what does this mean for our economy? Some good news, perhaps?
Yes, it is good news. I mean, for any oil producer, higher oil prices is definitely good news. For us in Nigeria, it means that for our 21, if the price remains elevated, it means that for our 2021 budget, we would most likely meet our oil revenue targets. We would be able we would meet our oil revenue targets. It means more revenue for the government. Before now, what used to happen is, if the prevailing oil price is higher than the benchmark oil price, currently our benchmark oil price is $40 per barrel, then the surplus would be saved in the excess crude account. I don't know if that still works, but if that works, that's some more savings for Nigeria. Then also the external reserves, to be positive for the external reserves, which have been hemorrhaging heavily due to the central bank's injection in the FX market, and it will also be positive for our exchange rate. Also, however, it's important to note that Nigeria's oil revenues is very, very sensitive to production. And production for October, I think, was about 1.5 million barrels per day, as Nigeria sought to, comply to OPEC production cut. So if our production is still low, then we may not be able to reap the full benefits of higher oil prices.
How much of an influence is the news of another progress in vaccine trial by AstraZeneca and Oxford having on oil prices?
big impact, BC. Very, very huge impact, particularly because this vaccine is cheaper than the other vaccines by Moderna and Pfizer. Also, it is easier to transport. This vaccine can be stored in normal fridge temperatures compared to the other vaccines that need to be stored in specialized freezers with temperatures of about negative 20 to 70 degrees Celsius. So it is big news. Also, it is increasing, it is bringing on this risk on sentiments in the global market. So we are seeing investors dump the US dollar as a safe haven and moving towards more risky asset. That is why you're seeing the dollar depreciate against a basket of other currencies. Also, it is positive in the sense that it means that the economic recovery in the global economy would be quicker than expected. Some people are saying, some analysts are saying by Easter next year, things should be back to normal. Some others are more conservative and saying by summer next year, things should be back to normal. So it's also positive for oil demand growth, the recovery in global economy. Overall, I think it's very, very positive for oil prices.
Which is what everybody wants anyway. Now, let's move away from oil now. Let's talk about the tension between West African cocoa producers, Ivory Coast and Kenya, and the chocolate companies, which doesn't seem to be weighing in on cocoa prices. Are we likely to see a continued spike in the prices?
So what is happening right now is, like you said, there's a price dispute between major cocoa producers and major cocoa buyers. So at the start of the cocoa main crop season in September, the government of Ghana increased the farm gate price of cocoa by 28% in order to account for, to essentially provide a living wage for the smallholder farmers of cocoa in Ghana. Same thing in Ivory Coast, the farm gate price was increased by 21%. So that happened on one hand. On the other hand, the buyers of cocoa are telling the producers that, look, because of COVID, the demand for chocolate is low, so we cannot pay these higher prices. So there's that dispute. And like you said, we've seen some cocoa buyers, we've seen this international chocolate maker Hershey's go to the futures market to buy cocoa rather than buying from the physical market, because it is quite cheaper in the futures market. So I hope that the buyers and sellers can reach a compromise soon. If that is not done, I think that cocoa prices will continue to trend higher, because Ghana and Ivory Coast control about 60% of global cocoa production, and they are forming something they call it COPEC, which is comes from the idea of OPEC, where they regulate the supply in order to increase prices. And I think that's what we are seeing at this moment.
All right, now let's talk about Forex now, Forex markets here in Nigeria. Over the weekend, the Association of Bureau de Change operators warned currency speculators that the CBN has enough reserves to shore up the Naira, yet we see the Naira at over 450 to the dollar at the parallel markets. What is causing the free fall of the Naira to other currencies?
Huge demand. That's the short answer. Huge demand. So as the economy is recovering, we are seeing more and more demand for FX by manufacturers. We are also seeing more demand as we approach the Yuletide season, the festivities. We are seeing demand for imports for the festivities. In addition to that, we are seeing there's this backlog before now, the backlog from Q2, Q3, where the central bank stopped selling FX to the currency to the FX market. So that backlog, all of them coming together at this time, is mounting pressure on the exchange rates. Although the central bank is injecting around 100 to 200 million into the foreign exchange market per week, but that is not sufficient to meet the demand. Also, because the fundamental factors are still remain. We still have a relatively low oil price and production. We have seen the mass exodus of foreign portfolio investors. We are seeing sharp declines in migrant worker remittances. So all these factors still remain. So we expect that the pressure on the Naira would remain, would at least up until the end of the year, the pressure will remain. Even though the central bank is injecting money into the FX market, I think it is not enough to meet the huge demand.
Now, Desola, whether we like it or not, Christmas is just weeks away, and already we are seeing prices of food items go up. Now, flour is expected to cost 11% more from December the 1st. What does this mean for bread consumers? Is bread now becoming a luxury food item?
By definition, a luxury good is one whose demand increase when incomes increase. Now, following that definition, we won't say bread is a luxury, but the fact that the price has increased means it's the fact that the price of the biggest or the main component of bread would increase means that only a certain number of people will be able to afford bread the way they used to. That means the price of bread would increase. With the price of bread increasing, I think that we'll see a shift. We'll see, first of all, we'll see lower demand for bread, and we'll see a shift towards substitutes like yam, breakfast cereals such as pap, cassava, and the like. So I think that is what would happen, at least in the near term.
Well, let's talk about rice now. Everybody loves rice. I mean, most people love rice. I mean, the festive season is approaching. Most people will consume rice, whether we like it or not. And the price,
Right.
it seems stable now at about 31,000 naira for a 50 kg bag. But invariably, the price is still quite high. Desola, you'll agree with me. Are there every possibility that market forces will push the price higher than what it is?
So what market forces are we talking about? Is demand and supply, right? So as we approach the festivities, I think that the demand for rice would increase, right? I'm not sure how. So I think that the demand for rice actually would increase, maybe more than the increase in supply for rice. So I think that prices may increase slightly because of higher demand during the festivities. However, because of incomes are squeezed now, and because of higher inflation, real incomes are squeezed now. I think that the demand, the huge demand that accompanies festivities may not be as high this year compared to previous years. So if the price would increase in December, I think it will be only marginally.
When you look at the price, the slide now that we're showing, you see that other commodities like onion in particular, I can tell you that because I'm a woman and I buy these things as well. Onion, eggs, chicken, tomatoes, they've all gone up. So give us a run through of commodities prices.
Okay, like you said, the biggest one is onion. Price of onion has increased 100% from last month. It has increased from about 40,000 per bag per 50 kg bag to about 80,000 per 50 kg bag. We're also seeing sharp increases in new yam. New yam, as a medium-sized new yam, has increased by 11% from 900 last month to 1,000 naira. We are seeing palm oil increase 30%. The price of 25 liters of palm oil increased 30% from 11,500 last month to 15,000 this month. We are seeing a basket of tomatoes also increased by 16% from 30,000 last month to 35,000 last month. So we are seeing all these sharp increases in the price of domestic commodities, and this is going to also reflect in food inflation. But some of the key drivers are, number one, insecurity. So in the aftermath of the EndSARS protest, there's been a sharp increase in insecurity, particularly armed robbery and armed banditry on the roads coming from the north down to the south. So there's now fewer lorries or fewer cargoes coming from the north down to the south. So that's one of the factors driving the cost of food prices, particularly here in the south. We are also seeing and the price of fertilizer also increased after the federal government banned the importation of fertilizers and trying to encourage domestic production of fertilizers. We've seen that affecting food prices. Also seasonalities in the planting season, which usually is associated with scarcity. We're also seeing that affects food prices. Then the festivities, so there's more demand during the festivities. So those are all the factors that are affecting our food prices at the moment. I expect and I hope that by January, the domestic commodity prices will taper down a little bit.
We do hope that that's what happens. Thank you, research analyst at the FDC, Desola Sumoni. Thank you for your input on the program this morning.
Thank you for having me.
We'll be right Well, it's also time for us to do a quick review of Monday's activities at the NSE. And the bear has just refused to let go of the market even after dominating 4 sessions last week. Yesterday, we saw the all-share index decline marginally by 0.4%. That reflected about a 9 billion naira loss in overall value of listed equities as investors begin the final week of November with a hangover of profit-taking. We'll see the latest round of sell pressure affected 46 equities across 4 key sectors of the market, and gains recorded by blue chips such as Dangote Cement, Nestle, Airtel Africa and Boa Cement only managed to reduce the impact of the market. But let's talk to David Adori, a stockbroker at High Cap Securities Limited, who joins us now for more on yesterday's trading and an outlook for today. Good morning, Mr. Adori. Thank you for joining us on the program. Now, the decisions of the MPC will be announced today at 2 p.m. Is that in any way likely to shape the market's direction for today?
Yes, good morning. It's a pleasure being with you. Yes, there is no doubt that the outcome of the MPC meeting will have an impact on the market because previous MPC monetary policies have shaped the direction of the market in recent times. Their expansionary monetary policy has increased liquidity in the financial system, and that enhanced activities in the equities market. It's also enhanced activities in the foreign exchange market. So the market will be feverishly looking at the outcome of the meeting to see if rates are going to be adjusted, either to further relax the monetary policy or tighten monetary policy. Whichever way it goes, it will have an impact on the market. But for this week, if the monetary policy is such that it tightens money supply, it means that equity will be adversely affected, and so there will be decline in equities. But if there is no change or monetary policy remains expansionary, it means that liquidity in the financial system will still be very high, and the probability that a lot of the liquidity will still flow into equities is very, very high. So that will still make the market to be bullish.
What is the market trading like at the moment?
The market is difficult to actually predict the direction of the market at a point in time during trading because it's fluid and it can change. The market is stable anyway. There are offers and there are bids. But at the end of the day, we will know which side of the market has superseded.
Stockbroker at High Cap Securities, Mr. David Adori, thank you for your time this morning.
It's a pleasure.
All right, we'll touch base with London when we return in just a moment. Don't go away. Now let's bring in Juliana Olayinka from our London studio to discuss this morning's major headlines coming from the UK. Good morning, Juliana. Let's start off with information coming from the Transport Secretary saying that people arriving in England will soon be able to reduce their quarantine period by more than half. Does this have anything to do with the AstraZeneca vaccine hopes?
Good morning, Bissy. No, these are two separate issues, although I'm sure Grant Shapps, the British Transport Secretary, would have been spurred by yesterday's announcement about the Oxford AstraZeneca vaccine. But as you know, we've been discussing this on this programme for quite a few months here, and quarantine restrictions has been a topic of much fierce debate here in the UK. Back in July, the hospitality industry were actually so annoyed with the government that they decided to take their case to the High Court just because they felt it was completely crippling, and the evidence does show that it has been. For example, I believe last month the Heathrow passenger numbers were down by about 88%. But there has been a change. The announcement was made last night, and now from December the 15th, just in time for Christmas and New Year travel, if you are coming from one of the countries that are considered a high alert level or a red list, somewhere like Nigeria, rather than quarantining for 14 days, which is what you have to do now, you can now quarantine for just 5 days, but you will have to pay for it. I believe you can take one of the swab tests or a PCR test on your 5th day of returning into this country, and if you do test negative, then you're free to go about your business. So the government are heralding this as a major scheme, and we did see a rally in the markets. I believe TUI, the travel tour operator, their shares were up by double digits. IAG, British Airways, and Aer Lingus umbrella company also saw their shares rally. But Michael O'Leary, he's the pretty fierce boss of Ryanair, the budget airline. He's still not happy, and neither are Heathrow bosses. They think it can be a lot more straightforward. I believe Heathrow at the moment have got some pretty fast turnaround tests in their facilities, but they want it to be much more simpler and allow passengers to take a test when they're at their holiday of destination. And so if it proves negative, then when they come back, they don't have to isolate. But given the kind of media round discussions that Grant Shapps has been having in Britain this morning, I think it's safe to say that this is probably as far as the British government are going to go when it comes to quarantining. So it will be reduced from 14 days to 5 days from December the 15th.
Meanwhile, Juliana, Prime Minister Boris Johnson is expected to unveil new COVID restriction plans today. What are we likely to hear?
We won't be getting anything about the restrictions today from Prime Minister Boris Johnson. We're expecting an update yesterday, but we had a big day yesterday in the House of Commons where Prime Minister Boris Johnson had an emergency address alongside the House Secretary Matt Hancock. Bearing in mind, Boris Johnson is actually still in self-isolation himself. So for the first time ever, we actually had, well, the second time, we had him addressing lawmakers from his flat above number 10, although there were some technical issues which was pretty embarrassing and had a few laughs. But the big question of this week, of really the next couple of weeks, is what is going to happen after lockdown. England is currently in a second national lockdown. We are having some reports from the scientific data that it hasn't really made a major difference in infections. Perhaps that's because schools are still opening. We know even though children don't get very sick, they can of course pass between households. So we're not really seeing a dramatic effect, and there are just a couple of weeks left till Christmas. The shops are closed. This is supposed to be the time where retailers up and down Britain can claw back some of their lost earnings from the spring and start making money. They cannot do that at the moment, and this is a cause of major concern. We had the first taste of what the British economy is likely to look like in November with that flash PMI data showing that there has been a massive contraction in business activity and business sentiment. So there are major concerns about that. Yesterday, when Prime Minister Boris Johnson spoke, he did suggest that we would be going back to this tiered traffic light restriction, albeit a little bit more stricter. And he's doing that because if we have 2 weeks of tough restrictions just before Christmas, then there perhaps will be 5 days but in the run up to Christmas and on Christmas Day where loved ones can gather and meet, and then it would get much tougher. But at the moment, it's all in the air, all speculation. But we do know that on December the 2nd, the England national lockdown will expire and we will transition into a tiered restriction. What that will look like, we'll have to wait until Thursday to hear an update from government.
Absolutely, Juliana, we need a clearer picture now. But having said that, what is the latest regarding Brexit?
Oh, goodness me, Brexit, the gift that keeps on giving. Well, what we know is that it's 6 weeks away, and at the moment, if there is no deal, Britain will come crashing out of the European Union in World Trade Organization standards and tariffs, and that's what the majority of people in Britain do not want, particularly the Bank of England Governor Andrew Bailey. He was giving a statement in front of a cross-group of MPs at the Treasury Select Committee yesterday. He actually said that if we do come crashing out of the European Union, the consequences for Britain will be far worse than what we've seen in COVID. And we know COVID has already completely crippled the economy. We are the worst severe hit nation economically in Europe. So he is putting the pressure on Boris Johnson to get a deal. He says the ramifications are going to be far worse than what we've seen this year thus far. We do know there was a halt to the negotiations. Somebody in Michel Barnier's team, Michel Barnier is the chief negotiator for the EU, tested positive for COVID-19. So all of the last-minute negotiations had to stop, and they have been taking place virtually. And sources do say that these negotiations are getting really tough. It's very difficult for them to try and sort out some of the major issues, sticking points such as governance, level playing field, fisheries, when they're not together. So we are expecting Michel Barnier, once he comes out of that 7-day isolation period, which is the Belgium national rules, to travel to London later this week to meet with his counterpart, Lord David Frost, to try and thrash out a deal. I've been saying this for the past couple of months, but we really are at a crunch time, and we are expecting some sort of announcement later this week. And I suspect, because of what the Bank of England governor warned yesterday, there may be more pressure on Boris Johnson to once and for all sign a deal with the European Union.
I guess we just have to wait and see. Thank you, Juliana. Do enjoy the rest of your day.
Thank you.
And back home, let's bring in the chief dealer fixed income at FBN Quest Merchant Bank, Ramat Baba, to talk us through the fixed income space. Good morning, Ramat. Thank you for joining us on the program. Now, quickly, I'd like you to tell us how's the MPC decision announcement later today likely to shape today's activities? Please do that in about a minute.
Good morning. So for now, not much is really happening in the fixed income market. Bond yields and treasury bill yields have pretty much remained flat in the last 2 days. A lot of people are speculating that the MPC might be holding rates, and as a result of that, we really don't expect any difference. Don't forget the country's leading into further recession. So, to be honest, a lot of people just feel there is no justification for a rate cut at this point in time. And of course, if the MPC chooses to hold rates at current levels, there shouldn't really be any impact in the secondary market.
All right, we'd like to thank you, Chief Dealer Fixed Income at FBN Quest Merchant Bank, Ramat Baba. Do enjoy the rest of your day.
Yes, bye.
And that's where we end today's program. Thank you for watching. I am BC at Debayo. Don't forget to join us at 1:30 as we begin to count down to the MPC decision day. Stay with us.